Welcome, everyone. So happy to see everybody online. We are thrilled and honored to have Dr. Joanne Feeney with us here this evening. Such a powerhouse in the industry of economics and the markets, and I so admire her work and how she looks at the markets. And so we're very privileged to have her here. So hi, Joanne. Welcome.
Hello, Kelly. Great to be with you. Yeah.
Yeah, pleasure. Okay, so we have a number of slides to go through here. So we'll switch to that in a minute. But I wanted to introduce Dr. Feeney because, I mean, she's just such a powerhouse. So we're, again, very honored to have her. So Dr. Feeney holds a BA in economics from Union College and earned her PhD and MA in economics from the University of Rochester. Her expertise, which is why we love talking to her, is primarily focused on the valuation of nanotechnology and semiconductor companies. In addition to that, in her career, she's been in the financial sector part of the economy. Dr. Feeney has also contributed her insights through consultations with esteemed institutions, including the Federal Reserve, the International Monetary Fund, and the World Bank. And she is a frequent guest on Fox Business, CNBC, Bloomberg, BBC, NPR. She's all over the place. So we very much appreciate having her here with us. So again, thank you, Joanne, for being here. Okay, so before I let Joanne jump into her slides, I'm going to share my screen and go through a few things here with everyone. Okay. First of all, questions that you guys have, I'm sure you're going to have questions for Dr. Feeney tonight. Let's save those to the end. Let Joanne do her presentation and then we'll monitor those. If we don't answer your question during the seminar tonight, then we will get back to you with the answers, okay? We perhaps thought we covered that topic, or it's maybe better offline. Okay, so again, Dr. Feeney, we're thrilled to have you. Okay, so many of you know I do have a radio show. Many of you found me through the radio show, KNX 1070 AM on the weekends. It plays from 7 to 8 AM on Saturday mornings. All of my radio shows are on my website, CaliforniaWealthAdvisors.com. Just click on the radio tab and you will find my radio shows. I think I have 4.5 years of radio shows on there. Lots of different topics we cover. Also on my website, I do have previous webinars. The previous webinars I've done with Dr. Feeney, as well as many other webinars on different topics as well. So go there and get a lot of information there. I did write a book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. I don't want anybody making blunders, so let's make sure you're avoiding those if you're getting into retirement or pre-retirement. So let me talk a little bit about how I look at investing and the key components to investing, which is why I bring people like Dr. Feeney to the table to all my clients, because I want you to get a broad view of what's available to you. So I believe you should have an investment plan in your strategy that's designed specifically for you. It's not portfolio A, B, or C. It's actually doing what you want it to do, whether it's income, growth, legacy passing, whatever it is you want out of your portfolio. We're actually tailor making this for you. So you've got to have a plan and you've got to have design specifically for you, but then you've got to have the correct diversification as well. And the way we do that is through the markets, which Dr. Feeney will talk about tonight, alternative investments and safe investments as well. And so this is my mass proprietary process, which again is on my website. And I've done seminars, webinars just on this. So people, if you're interested in looking more in depth at my strategy here, by all means go there. But M is the market, A is alternatives, S is safe money with my mass proprietary process. So M the markets, Joanne will be talking about tonight. Alternatives, those are anything that does not trade with the market. So it could be real estate, could be oil and gas write-off programs, could be gold or silver, anything that's different than the market. And then, of course, safe money down here. If you say, hey, Kelly, I just really want to have my money insured and safe, backed by insurance companies, that's where we go with some of those funds there. So it just depends on where you're at. Every client is different with what they like where. But I do like to cover that when I do these kind of webinars, because there's such a broad range of things to do to help you in your overall financial plan. So that's how we look at investing. Then I also have the private client process, which I created a few years ago to help people that really want me to look at their entire financial house, not just their investment dollars, which is the top part here, investment planning. But we look at your risk. What kind of taxes are you paying? What kind of insurances do you have? Is everything titled correctly that you own? So that's the risk part of your portfolio. And then your estate planning, of course, I am not an estate planning attorney, but I do work with quite a few, and we want to make sure your documents are up to date. If something should happen to you, do your beneficiaries, your heirs know what to do? Do you have a medical directive, a power of attorney? Again, the correct updated trust documents that you have. And then the family office services, or we call the vault as well, that's where you put all of your documents together in one place. So again, if your beneficiaries need information, they need a copy of a trust, or they need a medical directive or a passport, we put those in there as well. We've got everything in one place for you. So the private client process is really valuable for a lot of folks. And again, I have webinars on that on my website. So go look there. Okay, we're going to let Dr. Feeney take over from here. So I'm going to let her share her slides. So Joanne, you can go ahead and share and bring up your
Okay.
slide.
You need to turn on my sharing if you don't mind.
There we go. Allow. There you go.
Okay. Okay, you see that?
There we go. Yep, I do.
Okay, so glad to be with you. Thank you, Kelly, for your kind words. Always a pleasure to come and talk with your folks. So as Kelly said, I'm going to talk about the equity investing portion of where Kelly directs your portfolios, and more broadly about the economy and the situation surrounding that. So we want to talk about, so where are we in the markets, and some of the policy changes that are affecting investing opportunities and outlooks. Interest rates, are at the long end, that is 10 years, 30-year, not likely to come down anytime soon. The consumer has been the backbone of this economy. So one question is, will they continue to spend? And there's also this headwind of the size of the federal government budget deficit, and the accumulation of debt, and how much pressure that's putting on the economy, like interest rates. And then, of course, there's complicated geopolitics going on, whether it's the ongoing war in Ukraine, the Middle East, threats from China against Taiwan potentially, and other upheavals around the world. So those things all affect the investing environment. They affect particular companies. In some cases, it benefits them. In some cases, it hurts them. So we want to talk about all these, and just to let you know, these are the kind of things we take into account when we're selecting the individual stocks that end up in your portfolios. So at Advisors Capital, we're putting together, whether it's our balance strategy, our growth strategy, our income strategy, we're putting together individual securities, maybe 40, 50, 55 different positions on the equity side to achieve the goals you're looking for, whether it's a high dividend yield, whether it's more appreciation versus dividends. But we handpick these stocks in order to build a strategy that Kelly has identified suits you the best. Okay, now these numbers, just be aware, all the numbers I'm going to show you, this presentation was built a couple, 3 weeks ago. And that's because, Kelly has compliance rules, we have compliance rules, and they have to be approved. So just so you're aware, these are numbers as of July 25th. At that point in time, the S&P 500 had gone up, including dividends, by 9.5% roughly. But most of that came not from the Mag 7, as was the case last year. Most of this came from the other 493 stocks. And so that's a big change in the dynamics of the market, even though if you listen to the news, you'll often hear an awful lot still about the so-called Mag 7, Amazon, Microsoft, Facebook, Google, etc. So that's a bit of a broadening of the market, which is a good thing. Over the past 12 months, the market, the S&P 500 has been up around 20%. Nearly half of that came from the Mag 7. But again, the rest accounted for a bit more than half. So the Mag 7, because of this shift this year to date, has become less dominant. Let's just look at the top 10 companies in the S&P. And these are the weights, again, as of a few weeks ago, on average for the year. NVIDIA right now, by the way, is up to 8.2% of the S&P 500. So this is an average weight over the last 12 months. NVIDIA has risen over that time, and that's why the average for 12 months is only 6.4%, whereas today we're at about 8.2%. And as you can see at the top 10, most of them were up pretty well. The exceptions were Apple. Now, Apple, by the way, has since recovered a fair bit since this number was printed, because of the progress that they're making and some good numbers out of their earnings. Tesla has continued to struggle. The political aspects of that stock make it, in our view, difficult to invest in, because, as a modeler of the economy or of a particular company and its financials, there is just a breakdown, for example, between Tesla's stock and the business of Tesla because of some of the political overhang of Elon Musk's involvement in government activities. So maybe that will dissipate over time, but at this point in time, we just see that undefinable risk as unappealing from a stock perspective. You may be aware that Broadcom, ticker symbol AVGO, because it used to be called Avago, is one of the largest positions we have in most of our equity strategies at Advisors Capital. We've owned it since 2015. I have known the company since before they went public back in, I think, around 2009-ish. I was a Wall Street analyst at the time, and the little investment bank I worked for actually was involved in the IPO. I was probably one of the analysts covering Broadcom or Avago at the time with some of the highest estimates for their earnings out there. And the company kind of made a joke of it and said, yeah, we're always trying to beat your numbers, Joanne, because you're the highest on the street. And they did pretty much all the time. So it's a really, I highlight it because it's a good company from an investor perspective because it's diversified. It does software, it does hardware, it does chips, it's in iPhones, it's in networking equipment, it's in data centers, but it's also in cybersecurity. So it's a really great combination of businesses, and they're not so much chasing growth as they're interested in products that have deep moats that enable them to maintain very high margins. This is the sweet spot of investing. I wish we had 100 more Broadcoms out there, but we don't, and so we have to find alternatives. Okay, let's look at what's happened in the market. Again, this is through nearly the end of July. And these three charts, these three lines, show you the S&P 500, which is the blue line that ends up at the top here at the end, but otherwise in the middle. The white line is the Magnificent Seven, right? And as you can see, it got really hurt when the whole tariff day happened in April, but has recovered pretty sharply. And then the orange line is the equal weighted version of the S&P 500. That is, in the S&P, it's market capitalization weighted. That's why NVIDIA is 8.2%. This orange line is every company in the S&P 500 gets equal weight in this index being created. And as you can see, the S&P 500's equal weighted version actually is a bit less volatile. Right? Didn't drop as much as the S&P did, the blue line. But it hasn't risen as much as the S&P has either. So it tends to be a nice choice to monitor to get a better view of what's really happening among companies overall. Okay, the other thing I wanted to point out is how dividend stocks have behaved relative to this big market capitalization weighted S&P 500. So the S&P 500 in this chart is the white line. Two dividend-oriented indexes are in blue and orange. And as you can see in both cases, the dividend-oriented stocks have slightly underperformed the S&P 500. Most so for this SPY-D. This is the high yield subset of the S&P 500. And as you can see, that's vastly underperformed the market as a whole. In other words, high dividend paying stocks have not appreciated very much since that tariff day back in April. They've only recovered a little bit, and that's partly because the types of companies in the index, and also because these companies don't have as much growth, pay out a lot of their gross profits in terms of dividends. But really, when you look at that it says 1.16%, that's how much they've appreciated year to date. You have to add to that the amount of dividends. Yeah. A portfolio that's oriented towards dividends, you're going to give up a little bit in total return. And so that's something that that I'm going to actually shut down something because I'm seeing my internet connection's a bit unstable. So I want to reduce the other things going on here. So maybe that'll help. Can you hear me okay, Kelly?
I can, you were silent for just a few seconds, but now you're good.
Okay. Okay. So sometimes, one chooses to sacrifice a little bit in total return for two reasons. One, dividend better at night. But secondly, those dividend stocks are paying you cash, right? And if you're living on your portfolios, you're in retirement, and that cash is coming in even when stock prices fall, then you don't have to worry so much that the stock prices themselves are volatile because you're living on the dividends. And so it's a very attractive trade-off for a lot of clients.
Yeah.
And that's why some of our strategies, T3 balance, T4 balance, T5 balance, have become so popular because clients like to have the dividend cash flow, and that way they can ignore the fluctuations in stock prices.
Yeah.
So
That's a great point. I have so many retirees that I've created income for, use your strategies, and those dividend checks keep coming in. And sure, the market's going to go up and down, but we're not really worried about that. Because we want the income to live on, we need to recreate that paycheck.
yeah.
So a great point that you made there. Yeah.
So, one thing we like to look at is how expensive are stocks. And this is one way of measuring that. It's the price to earnings ratio, looking forward of earnings over the next 12 months. And what we've seen is that, recently, the stock market is expensive relative to history. It's trading at around 22.5 times. This hasn't changed much over the last few weeks. It's been more expensive during periods of time when earnings fall off a cliff. This is actually a mathematical ratio. It's price of the index divided by earnings. And so when the price falls, right, this PE ratio gets bigger. And so when prices fall, that sort of in some ways artificially drives up the index. But right now we haven't had that, right? The index has been going up and up and up, right? We're at record highs. And so I'm sorry, I said that wrong. When we go through periods when earnings collapse, like during COVID, right, the PE ratio is going to jump up, and that's an artificial increase because companies didn't suffer immediately because of COVID. And yet the PE ratio jumped up a lot. When stock prices fall, like they have done in 2022, if you remember, there was a big sell-off in technology stocks. You see the PE ratio going down. Since then, the market has recovered, right? The PE ratio has gone up. And when the market goes up by more than earnings climb, that PE ratio rises. And so it's a measure of how expensive stocks are, how many dollars you're paying for a dollar of earnings. And so right now, things are pretty expensive, but we want to dig down under the surface. So let's take a look at the PE of the top 10 stocks. These are the ones that include these high-flying AI companies like NVIDIA, Microsoft, Google, for example. And those costs of buying those stocks is really high. They're trading at almost 29 times, 30 times. And if you strip those out, the remaining stocks in the market are trading at 21 times. That's still high, but it is at least worth noting that there is still value in the market. You just have to look harder for it. Okay. But you might say, well, but those Magnificent Seven, those top 10 companies, they're expensive for a reason, right? They're expensive because they have strong earnings growth. And more importantly, they have strong earnings potential in the future. And so at this point, look at year to date 2025. This is again towards the end of July. The S&P was up 9.5%. Those Mag 7 stocks were trailing a little bit. But look where the earnings come from in the market. These are S&P 500 earnings growth. This last year, the Mag 7 had earnings growing 40%. The rest of the market, 4%. So that's why investors are willing to pay so much for these companies. Not only are they growing quickly, look at 2 years worth of growth there, but they're expected to grow more quickly their earnings than the rest of the market, 17% versus 7% this year. And next year, They'll slow a little bit, but they'll still, looks like, outgrow in terms of earnings the rest of the market. So if you want to own companies that are going to generate a lot of earnings for many years to come, there are some in this group of Mag 7 that you want to own because they're going to be the most profitable, big growing companies out there. So that's why some of these stocks are owned, even though they look expensive. Okay, profit margins have been doing very well in the market. They've been going up since the financial crisis. And they remain at near all-time highs at around 13%, 12.5%. We should be worried a little bit that the tariffs are going to impact profit margins because companies will not be able to pass on all of the tariffs they have to pay to bring goods into the United States. They will not be able to pass all of those tariffs on to consumers. So they'll have to eat some of those in the form of lower profit margins. Similarly, you may have heard about the export tax that the government wants to levy on NVIDIA and AMD to sell into China, right? That 15% export tax, they're not going to be able to pass that on to their Chinese customers. They're already charging them as much as that market will be able to bear. They're already extracting the highest prices they can. So that means that they're going to have to eat those export taxes. It's going to reduce the profit margins on NVIDIA and AMD products sold into China. So these profit margins are something we're watching when we look for what to own. Okay, real GDP, as I mentioned at the beginning, is largely distributed, out of what's being produced. Most of it goes to consumers, right? Some of it gets used for investment. Some of it gets used in government. And some of it gets used in, say, residential building. And so it's the consumer that we have to watch most carefully because they are the largest component of this. But the thing I wanted to point out here is that in the first quarter of this year, GDP, real GDP, that is extracting inflation, was actually negative. It actually fell. Real GDP growth was negative. And that's because there was a surge in imports. That's this big purple blob right here. There was a surge in imports because everybody expected these tariffs to come into play, and they wanted to bring goods into the country before those tariffs hit, before they had to pay that tax. And so it led to a big negative move in GDP growth. But in the second quarter, that reversed. And so it was a surge of imports. And then in the second quarter, the import level dropped substantially, and that actually turned into a positive. So overall, for the first half of the year, US GDP has grown about 1.3%. It's pretty low relative to average and what we should expect for a mature economy. It should be around 1.8%. But nevertheless, it wasn't the disaster that some people feared when we first saw that first quarter number. Also, so looks can be deceiving. That negative number had some people alarmed. But when we look at the data underneath that, industrial production was pretty good, still growing at, a couple percent a year. Companies were highly utilizing the factory capacity that they had and at around 77.5%. So, overall, the economy was looking pretty strong and still is. The consumer balance sheet is pretty strong. Yes, consumers have a lot of debt. And that debt goes up every year because there are more people working more jobs, earning more income. So it's natural for aggregate debt levels to rise. What we care about is how much debt service households pay, how much in interest charges, whether it's mortgage or cars or, lines of credit or credit cards or student loans. That is still very low. The percentage of disposable income, that is income after taxes, that make up debt payments by households is only about 11%. Back at the beginning of the financial crisis, it was at 16%. And even all the way back into 1980, it was only 12.4%. So we're lower than most of history. The only time we were lower was when COVID came along. People couldn't spend on anything, so they paid down their credit cards, right? So we're in really good shape from a household perspective. We're seeing some increase in delinquencies on auto loans and on cars, and student loan payments have resumed now, right after the COVID crisis expiration of those suspensions. So a bit of a worry. We have to watch out about the lower income part of the market. Retail sales have been pretty good. Real disposable personal income. This is something we have to watch. It was growing. So anything above zero is growth in, again, real, that is inflation adjusted after tax income, had been growing for several years after the COVID crisis first hit. But in the most recent data, it actually turned negative. And so that's a bit of a concern. There are fewer people in the labor markets relative to expectations. Inflation is still eating away a little bit at consumer income. And so that's something that could weigh on consumer spending going forward.
But do you think that will change though, with the administration bringing more businesses, more companies to the US to have production? Do you think that that chart will change when we
Yeah,
see more of that?
I don't think so because in order for more companies to manufacture in the US, we need a bigger labor force. Right? We need more people to work at those companies, right? If we want to take them from wherever they are outside the US and bring them here, we need the labor force to be able to work in those firms. And we don't have a lot of growth in the labor force. In fact, the labor force has been growing far more slowly than it had been because of the loss of immigrant labor. So it's going to be very difficult to bring businesses back to the US given the constraints on the labor force. What we're seeing instead is actually, and it's not going to show up in personal income, but it's going to show up in affordability numbers. So consumers, some of those, they're going to have to bear the cost of some of those tariffs. People are estimating that if the tariff is, raises the price of something by $100, raises the cost of something by $100, that firms will be able to pass on about 30% of that. So that means the price of goods goes up by $30 in that case. So that's going to constrain household budgets. All of a sudden, things that you're buying, whether it's a washing machine or a broom or, paper products, these are going to cost potentially a bit more, depending on how big the tariffs are and how much companies can pass through. So while personal income might remain fairly stable, the affordability is going to go down because of these higher prices. And so that means they're going to be able to afford to buy fewer goods because their paycheck is not going to go as far. And so we could actually see less stuff being produced because consumers just can't afford to buy as much. So that's one thing we're watching pretty carefully. And as you can see, the payroll gains have slowed, and that makes sense. There was a big spike after COVID. More people were employed, right? And that those numbers have gotten smaller over time, which makes sense because we're at nearly full employment, right? Also, that labor force growth has slowed. A bit of a spike last year, but it's down again this year because, again, mostly because of the loss of immigrant labor. And we're going to see how that plays out because of the step up in some of the efforts to remove immigrants from the United States is going to hit certain industries more than others, but it is going to lead to a decline in the overall growth of the workforce. Construction, services, travel and leisure industries, restaurants, and home building are all areas which have a lot of immigrant labor. And those are areas where we think there's the impact is going to bite most drastically. But hey, we're in pretty good shape. Unemployment rate is low right now. It's about 4.1, 4.2%. Wage growth is still pretty high, 3.9%. And so this is nominal wages, dollars you get paid. And inflation is still pretty moderate, about 3%. So, households are eking out a bit of gains from wages growing a bit faster than inflation right now. So that's a positive for the consumer. We just got some new CPI data. It's not on this chart. It's ticked up again. It was up around, the core was up around 3.1% as was revealed yesterday. And that, shows that there is some impact of ongoing shortages of labor in the service sector, a bit of impact of tariffs, but we haven't seen the biggest impact of tariffs yet because the higher tariffs just kicked in last week. So that's going to feed more into price data going forward. And personal consumption expenditures, of course, it came down after the immediate recovery from COVID. This drop is not alarming, right? It's stabilized right over the last year. That's a good sign. So we're just going to watch to see what happens with tariffs. Inflation expectations have moved higher because of the tariffs. And that's something that's not surprising, but it is why the Fed has been reluctant to cut interest rates. They recognize that these tariffs are going to lead to higher prices, and that's going to be a slow roll over time. We're not going to get a one-time increase in prices because companies are going to test the boundaries. Can I raise prices by this much because I'm paying a 10% tariff? Oh, maybe I can get away with a little bit more. Oh, maybe this industry decides to, add some to try to buffer the effects of the tariff. So it's going to be a slow rollout. And therefore, we're going to see some ongoing price increases. In other words, ongoing inflation. So that'll keep the Fed on hold for a little while. But they probably cut in September because the job numbers were so weak over the last few months. But ultimately, they're going to have to balance the job weakness with the tariff pressures. Okay, and so just a snapshot here. Right now, it looks like tariffs on average are going to be around 15 to 18%. This is new data that's come out since July 25th because there was an imposition of new higher tariffs since that date, if you recall, whether it was 39% on Switzerland or 50% on Brazil, or, there's a lot of higher tariffs out there. So it's more likely a bit higher than this. And that's not something we've seen, since 1933, roughly. These are the years, by the way, 1900 to 2020 here. So we'll see how this plays out. It's not something we've seen in a very long time, but it is something the Fed's going to have to watch carefully. Okay, government has also curtailed spending in other places, in addition to offering some pretty generous tax cuts, mostly to corporations. 100% depreciation as a tax cut is pretty appealing. The reinstatement of the R&D tax credit is pretty appealing for companies that want to invest. There is a pretty big hole in the budget. That's something that's going to continue to put upward pressure on interest rates because the government is a big borrower. They crowd out a bit of private borrowing because they push up interest rates. That's a bit of a headwind. Nothing drastic is happening, however. So, folks that are really concerned about the deficit getting out of control and the debt getting out of control shouldn't worry right now. There is plenty of growth in the U.S. economy to support the growth in interest payments over time. Okay, yields have come down a lot. The 10-year, though, remains pretty high, and that's the rate upon which, by the way, mortgage rates are primarily based. So the Fed could cut short-term rates. This is this lower number here. It's not going to do much to reduce long-term rates, which is the basis for mortgage payments. So it's a bit, as Fed Chair Powell has remarked, their policy, which is just on the overnight lending rate, the federal funds rate, they refer to it as a bit restrictive. Because it has led to higher real borrowing costs, and those are sustained above what they would consider the natural rate. And so that's why we might very well see them cut rates, particularly given the labor market weakness we saw the last few months. So we shall see. Okay, other policy issues that we look at when we're trying to select those 40 or 50 or 55 stocks is how the impact of the extension of the 2017 tax cuts affects companies' income statements. That I mentioned the upfront depreciation, which will reduce their taxes and increase their cash flow. That reinstatement of the R&D tax credit. And by the way, there is definitely an expectation that there will be higher defense spending, not just in the United States, but globally, for a few reasons. One is that there was a lot of depletion of our arsenal, whether it was jets or missiles or bullets, because of the ongoing war in Ukraine. And secondly, because of the U.S.'s signaling of a pullback to involvement in NATO to some degree, and an increasing threat from Russia, particularly in places like Finland and Sweden and Northern Europe and Central Europe, the European countries have decided that they had better shore up their own defenses. Because the U.S. apparently is will be less involved. So higher defense spending globally is a tailwind for a lot of companies, not just the defense industry, but suppliers to the defense industry. There are also several headwinds, as I mentioned, labor shortages. This has been going on for a long time, by the way, before the immigration policy change that we've seen this year. There's also likely to be a higher number of uninsured consumers and households because of the cutbacks to Medicaid and by implication Medicare to some degree. And so we're going to have more uninsured people. And it's not clear whether they're going to find alternative insurance or whether it's going to mean a decline in demand for various types of healthcare services or increased cost to hospitals because they might get more emergency room visits. So, hospitals may not be the thing to own right now because of that anticipated inflow of ER visits because of the higher number of uninsured. Also, we're seeing lower transfer payments to lower income households because of the cuts to the food assistance program. So these are things that exacerbate a problem we've been tracking for a while, which is that you've got to think about the consumer not as one aggregate, but as lower income consumers versus higher income consumers. The lower income consumers were the ones that were most hurt by inflation. And so their budgets were already under pressure. With these changes in healthcare coverage and transfer payments, their budgets are going to be more under pressure. So we've avoided a lot of companies that are really exposed to the lower income consumer over time. Companies like Dollar General, for example, right? And favored companies that the upper middle class moves to when their budgets get tighter, because of inflation, for example, like TJ Maxx, has been a real winner because of tightening budgets in households in the mid-range and even the upper mid-range. And so these details are things we're going to look for when we pick these stocks. We might see more tariffs, by the way, besides just these country-specific tariffs. There's been discussion of tariffs on semiconductors, on drugs, on lumber. And we've already seen some of these be imposed, like on copper, steel, and aluminum, which several companies have highlighted as raising their costs and cutting into their margins. So these are all the things we're taking into account. Also, longer term concern is lower spending on basic research, whether it's the decline in funding for the National Science Foundation or the NIH or university laboratories. This is something that's a long-term effect. Kelly, you remarked on how, right, you've helped your clients understand that they're in it for the long term.
Yeah.
Right. So lower spending on basic research affects long-term growth of the US because it's the stuff that led to the basic discoveries in material science that then companies could take and then innovate on and create new products. So less basic research means we're going to see potentially less growth in the US. So that's something we're watching pretty carefully.
Well, let me point out here, that's why I love Advisors Capital and what you do, Dr. Feeney, because you pick individual stocks. You're really researching the individual stocks and you're looking and you're forward thinking, and you were brilliant at this during COVID. You're forward thinking, what's coming our way? What can we take advantage of? And let's get rid of the stocks that we don't feel like are going to perform as well and go into some stocks that we feel like the economy, based on everything you just said, are really going to participate in. So, I mean, yes, we have 2-year, 5-year, 10-year investments that I recommend for all of my clients. These are not 1-month investments. If you want to trade in and out of the market, that's not what we do. That's not what Advisors Capital does either. We are long-term. So we're going to be forward thinking. And again, that's why I love Advisors Capital, because they're very specific in the stocks that they pick. They're not picking 500 stocks like a mutual fund would. They're going to pick based on your strategy. You want, let's say, dividend stocks. You want income coming in. They're going to pick 40 different dividend stocks, and they're going to be very proactive with how they're managing those. So a brilliant, Dr. Feeney. I love that you guys do that.
Yeah, it's certainly been a challenge. But one thing I want to point out is how strong at least the S&P 500 companies have been. This is a graph here that shows you earnings growth in the different sectors. And so the companies in those sectors in the S&P 500. And so there's a categorization. Some companies are communication services, some are utilities, some are financials, et cetera. But on average, last year, earnings growth for the S&P 500 was about 9.5%. That's a lot of earnings growth. That's why the market has gone up. This year, earnings growth is expected to be about the same, 9.5%, led by information technology companies like NVIDIA, AMD, Microsoft, and communication services like Google or its parent Alphabet, and even a recovery in healthcare company earnings after a pretty tough year last year. The laggards, energy. Why? Oil prices have dropped. And they were making just a lot of profits last year, much less this year because of those lower oil prices. Consumer discretionary, not much growth expected for this year. Why? Consumers under more pressure. Years of accumulated inflation, right, has put the budget under pressure. Next year, we're expecting, at least the market is expecting higher growth, almost 14%, led by energy because comparables, that is comparison of next year to this year, is going to be a lot easier. This year, the earnings are down a lot. Next year, probably recover a little bit because the expectation is that oil prices will go up from here. That's going to feed
Well, and
directly.
we need more energy too for the AI and the technology industry.
That's right. It's a global market for oil and natural gas, but this is happening all over the world. That's exactly right. And that's why utilities next year are expected to see earnings growth of 9% because of that demand. So that's a pretty positive outlook. I think probably this number is too high. I think this is overly optimistic, but we'll see. And as I think I might have said, this might be a repeat, but yeah, the Mag 7 has been the leader in growth. It likely remains the leader into next year as well, most of the year. But we're seeing some catch up expected as other industries grow also, whether it's materials or industrials. Consumer discretionary looks to recover next year, and consumer staples. So looks like a pretty broad recovery in a lot of industries that have been laggard, which particularly included materials and industrials. Okay. Okay. One of the things that we look for in balanced in particular is where can we find growth to put in the portfolio that isn't high risk growth? And where can we then find income to balance out the dividend yield we can get of the portfolio? Growth companies are not known for paying high dividends, right? Microsoft dividend is 1% or less. Broadcom used to be one of the best dividend payers out there, but the stock has appreciated so much that the yield is now well below 1%. But we really like them for clients because they deliver appreciation over time, because these are companies that have growing earnings. What we're seeing as sources of growth is tied nowadays to these generative artificial intelligence investments in capacity that enable companies and consumers to use artificial intelligence to do all sorts of things, whether it's getting more efficient answers in a web search, to researching how do I fix the broken water pump in my house or whatever, right?
Right.
So and then companies are saying, how can I make my back office more efficient? Is there a way that I can get better data to know to what regions of the country I should ship this product versus that product? So the use of AI is growing across different industries and households, certainly, but all of that costs money. It means we need more data centers to handle all that computing request that's coming over the internet, right? And so the massive increase in spending on capital, that is the computers and the new buildings and all of the wires that connect these computers, these big servers, and of course the chips that go into them, like those from NVIDIA and from Broadcom, that all costs a lot of money. And we've just seen a massive explosion in that spending. That fuels future growth. That fuels future profits. So that is what's been the source of growth. I view this as the growth engine of the new economy, and it's likely to continue for several more years as the spending forecasts suggest. Okay, so I don't think we need to get into these details, but here's one last slide I wanted to share with everybody. Be aware that stock pullbacks are common. They happen every year. And in many years, more than half of the years of the last 30 or 40, those pullbacks have been greater than 10%. So the red dots are the low point of the year. Back in 2021, 2020, 2022, the market was down at 1.25%. That was a lousy year. It ended up down 19%. But in most of the years, when the market's been down 10% or more at some point in time, the market ends up. These are the final points where the market ended, these gray bars. So most of the time, we see significant drops in the stock, in the price of the S&P 500 during the course of the year. But in most of the cases, the market ends up the year up. And so don't be alarmed. Like earlier this year, the market was down 19%. But it's already recovered. This is even older data. This is just the end of June. The market's already up 9.5%, 10%, right? A little bit more today. So one has to be able to ride out these ups and downs. They're going to happen almost every year. And so listen to Kelly, stay invested for the long term, and let us handle figuring out which stocks to own, keep you diversified, generate the income you're looking for, and hopefully to generate enough appreciation that we meet your investing goals.
Absolutely. And as you said, I recommend to clients, these are 2-year, 5-year, 10-year investments. The longer you stay invested, the better chance you have of making money.
Right.
So stay invested, don't try and time the market. I mean, these are all in my book that I wrote as well. Thank you, Dr. Feeney. I really appreciate you. So I do have some questions from listeners, if that's okay.
Absolutely.
First one, how will AI affect the job market?
Yeah, good question. Yet to be determined. We are getting some indication that some entry-level jobs are being turned over to AI tools, which is not really that sustainable because firms need to train people. And entry-level jobs are often the way young workers become exposed to the company, its products, its procedures. It's a way the company trains them to build up their what we call human capital, their own personal productivity and their ability to contribute to the company. So eventually there'll be some balance and companies will figure out, okay, I can use AI for these tasks, but I need to partner that capability with real humans because I need humans to learn how the business works so they can become more productive over time. But yeah, we're certainly seeing signs in certain areas where AI tools are saving companies a lot of money, and we're going to see more and more of that. So it's likely to be very disruptive and sort of unpredictable.
Yeah, interesting. We'll see what happens. Okay, next question. What will happen if the Fed doesn't lower interest rates?
Not much. I think at this point they have a dual mandate. They have to, one, try to maintain stable prices as defined by 2% inflation, according to the PCE, not the CPI, but the PCE. But their other mandate, which, is equally important, is to maintain the health of the job market. And right now we're pretty much at full employment, 4.1, 4.2% unemployment. So there's nothing alarming yet in the labor market, but the last 3 months of job creation data, net jobs created, ended up being a fair bit lower than anybody understood at the time because the survey data gets added to. So the first release of the monthly jobs data is, with some amount of data, all the data they can collect, and then they get more data over time and they update the numbers.
Yeah.
And so these revisions are part of the natural process of collecting more and more data, and that takes time. And so what we found out is that there were far fewer jobs created over the last few months than was understood at the time because we got better data over time. And so that's a little bit worrisome. So the Fed may very well pivot, try to lower interest rates to keep businesses willing to spend, to invest in capacity so
Yeah.
that they can hire more people.
Right.
But the Fed only controls the overnight lending rate. They don't control the 10-year. And ultimately, that's going to determine how much companies have to pay to borrow if they need money to do that expansion. So if they don't cut, that will maintain the expectation that inflation will stay under control. And that's a positive. If they do cut, it'll probably just be a little, 25 basis points, maybe 50. And that probably isn't too much to cause damage to inflation expectations, but that's the risk they have to manage.
Okay. Next question. What about these tariffs? Will they bring back inflation?
Yes, definitely. And the question only is how much and over what period of time. And that's why the Fed has such a difficult job at this point. They're in a damned if you do, damned if you don't situation.
Yeah. Okay, last question here before I let you go. How does Advisors Capital pick stocks for the different strategies you have? Well, you kind of covered that a little bit, but it might be beneficial to go over it just a little bit. How do you pick the stocks that you're looking at?
Yeah, so what we do is look at a lot of the variables I just went over, right? And look at the big trends. How is the world changing? I mentioned AI, but there's demographic changes around the world. There's innovations in, technology and healthcare. And so what we do is we look at all those big things. We look at politics as well. We look at monetary policy. And then we say, okay, this area looks good, this area looks bad. And then we try to find in the areas that look good, which companies are the best. And then we go into the deep dive of looking at their financial statements, right? Looking at their products, looking at their competitors. Do they have a deep moat? Can they protect profit margins? So how much are they growing by revealing new products? How much can they charge for those products? How can they protect their profit margins? What's the competition? And then what are they doing with the money they do make? Are they a responsible management team? Do they use the money to invest in new products to create more growth? Do they use the money to buy companies, and do they do it smartly? Do they make sure not to pay too much? Or do they return the cash to shareholders in the form of share buybacks or dividend payments? So these are all the things we look at.
I love that you said that. Once in a while, I'll have a client come to me and they're looking at their 40 stock and they say, well, I like this stock, I don't like this stock, I don't like this stock. And I'll look and I say, okay, what you just said there, Joanne, is brilliant, because I'm not going to try and tell you guys what to buy and sell. This is your job to do that deep dive and find out what the cash flows and all those different things. So again, these are 2-year, 5-year, 10-year investment strategies that we do for folks. So yeah, stay the course, I think is a good sentence there for everyone. Okay, Dr. Feeney, I'm going to go and share my screen again before we head out here with you. So those of you listening here tonight, we do have more seminars coming up, a number of them on real estate, 1031 exchange. We certainly have our Christmas party coming up in December. So if you're a client, you are definitely invited to that. But we always are adding more here. We have some tax write-off programs coming to the table as well coming up here. So those of you new to me, call the office. Here's the number. My email is there. If you're new to me, I like the first meeting to be in person. That's my preference, either in my Anaheim office or my Santa Barbara office. I want to shake your hand, get to know you, see if I can bring to the table what you're looking for. I can do Zoom meetings as well and phone calls certainly, but we do stay very much in touch with our clients, and so getting to know you is very important to us. So again, thank you very much for everyone that's attended this evening. If you have any questions or you asked a question we didn't get to, we will get back to you. But thank you, Dr. Feeney. So appreciate your time and efforts. Really appreciate your expertise. What a pleasure for us to have you.
Always glad to be with you, Kelly. Thank you.
All right. Thank you. All right, everyone, we'll talk to you soon. If you have any questions, again, just let us know and we'll take it from there. All right. Take care now.